Now, let's return to a measure of investment that may be, in fact, more familiar to you, and that's the ratio of investment to GDP. As we saw in country X, for example, that ratio has been a little bit over 30%, but it's been coming down, okay? You will find that that same ratio in Diagnostica over time has been somewhat lower, okay? Now, it is, I think, fairly easy to see that the ratio, that the flow of investment, if we're measuring it in, let's say, dollars or dinars, is equal to the ratio of investment to GDP times GDP itself. So, for example, if the investment ratio is equal to 30%, 0.3, okay, and GDP is equal 100, then the flow of investment in dollars or dinars should be equal to 30, okay? And that should be simple enough, okay? And once again, as we see, this is investment that's measured in the country's currency, real units, say dollars or dinars. Now, we can see also that in this, measured this way, the flow, the dollar or dinar flow of investment can rise for one of two reasons. Either the investment to GDP ratio rises, or GDP itself rises. And it's this last point that gives rise to an interesting perspective. Investment can rise when GDP rises, even if the investment to GDP ratio stays constant, okay? So let's go back and ask ourselves, why might GDP rise? Let's go back to our production function, okay, with labor, capital, and TFP, and let's think just a bit more about TFP. Now, in most countries, TFP does tend to rise over time. And moreover, when TFP goes up at one particular time, it tends to stay up. Why does this make sense? Well, first, let's think about the technological component of TFP. Let's think of a new invention. Once we invent something, we tend to keep using it until we find something better. We don't uninvent things. So in this case, you could see that TFP should go up and it should stay up after the technological innovation. The same thing typically happens with reforms. When we implement a reform and the reform remains in effect, that is, if it's not repealed, then this again would mean that TFP would go up and stay up. In either case, higher TFP by itself would boost output. But often that additional output will spill over and encourage more capital accumulation. And you can see why. Since the dollar amount of investment equals the investment ratio times GDP, GDP has risen as a result of the higher TFP. The dollar amount of investment can rise even if the investment ratio itself is constant. We have a name for this. We call this the induced investment effect, okay? This effect has important implications for the long run. Now, let's take a short-run perspective on TFP growth. In the short run, TFP just has a direct effect on output. But then, when we go over to the long run, we can see that in the future, the TFP, through its impacts on output, will have these indirect or induced effects on capital accumulation, not only today, but also out into the future. So we can think about TFP as having in reality two effects. In the short run, by definition, TFP rises and output rises through a direct effect. In the longer run, we have this induced investment effect. And the bottom line here is that higher TFP from either technology or productivity-enhancing reforms will likely can boost capital accumulation and growth through their impact on induced investments. However, I want to add a note of caution here. These impacts don't take place immediately. The extra capital accumulation that results from higher TFP growth, or that can result, will instead, likely, if they occur, will occur on an eventual and gradual basis. Okay, so now, as I mentioned, we're going to be thinking of the investment ratio, the gross investment ratio, because remember that our investment figures are in gross terms, but we're going to be doing this as investment here as a fraction of the previous period's capital stock. So here we have, this is a 75 billion, but our previous period's capital stock is estimated here at about 1.6 trillion. So let's tie that in here. Okay, now we're going to multiply this by 100 because that's the convention that we've been using. So you can see that our gross investment was about 4.7%. Then, okay, we've made our assumption already. It may be a kind of a heroic assumption, but we've made our assumption of a constant depreciation rate. Okay, so we're going to pin that down. Once again, to make this compatible, we have to do this 100 times that, which is fine. And then we'll get our net investment ratio, and that's basically the difference between this and this. And once again, since we pinned everything down, okay, we have okay, and we can also do some averages here. So I'm going to ask you to be calculating some averages here, and then momentarily we'll be moving to a handy table.